What's going on YouTube? My name is Chris, and if you're new to this channel, welcome. I'm a YouTuber looking to put the fun in finance. When you subscribe to my channel, you'll get videos related to investing, finance, the markets, and even how to use credit cards. If any of these topics interest you, you should definitely like this video, subscribe, and comment down below on what you'd like to see. Today, I'm going to share 3 dividend stocks that aren't exactly sexy stocks. Wait, am I allowed to say that word on YouTube? These stocks may have unspectacular capital gains, but they can help you get passive income. And while nothing is 100% safe, these may be more viable options for you to preserve capital and put some cash in your pocket. I'll quickly go through a discounted cash flow analysis, determining the intrinsic value of equity, and provide a margin of safety. Are you ready? Let's get started. You better stay woke, because my first stock is Coca-Cola, ticker symbol KO. Coca-Cola is currently down 17% year to date and about 23% from all-time highs. We all know Coca-Cola, so we don't really need to get into the specifics of their business or their products, but as a fun exercise, why don't you let me know down in the comment section down below what your favorite Coca-Cola flavor is. Is it the classic regular Coca-Cola? Is it Diet Coke, Coke Zero Sugar, Cherry Coke? Coca-Cola reported earnings a few weeks ago, and their revenues and profits were quite strong. However, they also cited that they almost saw a cliff fall in sales during April due to this whole health crisis. They're obviously going to be affected by declining sales from restaurants, concert venues, stadiums, vending machines, pretty much anywhere where you can buy Coca-Cola products, and not just in America, but globally. However, they have an incredible balance sheet and have generated positive free cash flow consistently. A ham sandwich could run Coca-Cola. We all know Warren Buffett loves his Coca-Cola stock and loves the Coca-Cola drink even more. The business is so well run, even a caveman can do it. Wait, that's a slogan for another company. Coca-Cola is also in the consumer staples industry. Companies categorized under this industry are generally companies that will always have demand, regardless of what's going on in the world. You can think of products like TP, toilet paper, medicine, or in this case, beverages. I guess you could consider the consumer staples industry as a relative safe haven compared to other industries since they are less cyclical. Coca-Cola has paid a dividend every year for the last 60 years. They currently pay $1.64 per share annually and have a pretty healthy dividend yield of 3.6%. You can determine a company's dividend yield by taking their total annual cash dividend divided by their share price. For a company that's paid a dividend for as long as they have and actually have increased their dividends over time, Coca-Cola has proven to be a resilient stock for over 130 years and can help you generate passive income. Another thing to look at is PE ratio. PE ratio is used to compare whether or not a stock is overvalued or undervalued. You can compare this to a broad index such as the S&P 500. Coca-Cola currently has a 20.55 PE ratio, which I think is pretty reasonable considering the S&P 500 index has a PE of about 19.66. One can say Coca-Cola is fairly valued. The price to earnings ratio indicates the dollar amount an investor can expect to invest in a company in order to receive $1 of that company's earnings. So, if a company's PE ratio is 20, you would expect to pay $20 for that stock in order to receive $1. One can interpret the PE ratio in a number of ways, and we can't go over all of them now. However, it is one of the most popular ways to value a stock. A high PE ratio can show that a company is overvalued or that the market is simply expecting higher earnings growth. A low PE ratio can show that a company is undervalued or that it's performed well relative to past trends. So you can really tilt the PE ratio in whichever story that you're trying to make. One thing that people don't understand, cola has no taste memory. You can drink one of these at 9 o'clock, 11 o'clock, 5 o'clock. You can't do that with cream soda, root beer, orange, grape. You get sick of them after a while. There's no taste memory to cola. As one of the most popular companies and well-known brands globally, I think Coca-Cola is a great company at a good price. They've been around forever, and I think they will be around forever. They pay a dividend, so even if a stock price doesn't move much, you'll still be able to clip the annual dividend and create passive income for yourself. Quickly touching on the intrinsic value of the stock, after tweaking some of my numbers in my previous DCF, I got the fair value of Coca-Cola to be about $53. Applying a 10% margin of safety, which is just the area in which the investor should be willing to invest, I got around $48. If that wasn't too clear, you should definitely check out my other video where I go a bit more in depth into this discounted cash flow analysis. With Coca-Cola trading just about around $44, I think this is a pretty good price to buy, even with some potentially rough waters ahead. If you want my next dividend stock, please smash that like button and subscribe. I'll wait. Just kidding. Let's go. My next stock is not PB&J, but J&J, Johnson & Johnson. Johnson & Johnson is currently up 2% year to date and about 4% down from all-time highs. Everyone knows Johnson & Johnson. We don't need to go over all of their products, but you need your lotion, your ibuprofen, your drugs, your medicine. I'm pretty sure you can go into your medicine cabinet and about 50% of the products in there are J&J products. That's why Johnson & Johnson is such a powerful company. They're one of the largest pharma companies in the world, and they're pretty much in every household. They are also considered a consumer staple company like Coca-Cola, so regardless of what's going on in the world, you're going to need their products. They also crushed Q1 earnings. As we were all bunkering in, Johnson & Johnson sales increased dramatically. Makes sense. They also increased their annual dividend by a whopping 6%. Anytime a company increases their dividend, it makes their stock more attractive. They're paying you more money. Duh. They currently have a 2.74% dividend yield and pay $3.80 per share. However, with the most recent increase in dividend, Johnson & Johnson will now pay $4.04 every year and have done this for almost 50 years. A huge upside play for Johnson & Johnson will be whether they play a role as a vaccine candidate for this health crisis. And while I don't want to be too insensitive, this would be great for Johnson & Johnson stock. Moving on to the intrinsic value of the company, I get a fair value of Johnson & Johnson to be around $174. And applying a 15% margin of safety, I get to a price of $148, which is about right where the stock is trading right now. I think Johnson & Johnson could be a great opportunity for you to increase your passive income while potentially getting huge upside in capital gains. My next stock is, can you hear me now? AT&T, ticker symbol T. That slogan is actually for Verizon, and then that guy moved to Sprint. So it actually has nothing to do with AT&T. So AT&T's main appeal is their large dividend yield. What did you think I was going to say? AT&T is down currently 24% year to date and actually down 50% from all-time highs. AT&T currently pays $2.08 per share annually and is trading around $29. They currently have a dividend yield of around 7%, which is actually very high. For reference, an average dividend yield for the S&P is about 2.5%. To be clear, a high dividend yield isn't always a good thing. Sure, AT&T's 7% dividend yield is about 14 times higher than what you can get on 10-year treasuries. The denominator is the stock price. So a high dividend yield could be a sign that the stock is actually trading at a steeper discount than it should be, ultimately showing that the stock is underperforming compared to the cash dividend that it's paying. AT&T actually increased their cash dividend by a whopping 1 cent. Now this might not sound like a lot, but for a company to be able to first of all pay a dividend, and then on top of that increase their dividend by any amount, shows that the company is in probably pretty good standing and is able to generate positive free cash flow to pay this to all of their shareholders. The issue comes when they raise their dividend too high, or they have to lower their dividend or pull it altogether, which is what we've seen airline stocks do during this time. AT&T's biggest issue is that they have a ton of debt. They levered up quite a bit to make a few acquisitions, such as DirecTV and Time Warner, and their total debt is huge. This will be the main focus over the next couple of years on how they will reduce this debt. However, they also have a ton of cash. I'd say AT&T is definitely the riskiest out of these three stocks because if they can't pay their outsized debt, that's obviously going to be a problem. They also have a pretty big pipeline coming up. They have HBO Max in order to compete in the streaming services industry and will play a vital role in the move to 5G. Moving on to the intrinsic value of AT&T, I calculated the fair value of equity to be around $55, and with a 15% margin of safety, it gets us to right about $30, which is where it's trading right now. I think AT&T will be around in the long run, even post this pandemic, and with a dividend yield of 7%, it's pretty hard to give up this great value. I think these could all be great options for somebody that's looking to invest in a grinding stock market and looking for passive income. I would be careful on how you deploy your cash though. I definitely wouldn't invest it all at once, and I would practice dollar cost averaging. You should understand that the economy is a long ways away from getting back to normal, and that there could be some ugly price action in the short term. Also, you should note that my fair value assumptions were just my assumptions. They're my projections and growth rate, and will be subject to change based on what inputs you use. What do you think about these dividend stocks? Let us know down in the comment section down below. If you like this video, make sure you smash that like button and subscribe. See you another time.